Fine. So let us quickly start with the revision of salary chapter. First and foremost comes the concept of salary. Salary is the first head of income, and salary arises only when there is a employer-employee relationship. It arises because of the employer-employee relationship. How does the employer-employee relationship comes? If there is a contract of service, it is salary, but if it is a contract for service, it goes into PGBP chapter. If salary is given to partner, partner is the part owner, hence it will not be taxed in the salary head of income, it will be taxed in the PGBP head of income. So salary to partner, even interest to partner, remuneration to partner, commission to partner, everything will be taxed under PGBP head of income in the hands of partner. Then salary given to MP, MLA, etc. will not be considered as salary, it will be taxed in income from other sources chapter. Whether salary is full time or part time, it does not matter, it will be taxed under salary head of income only. Then if the employee has forgone the salary, still it will be taxed in the hands of employee, because foregoing is only utilizing the income. Then however, if salary is surrendered to central government under a special scheme by the central government employee, then it will not be considered as salary. Sir, what about tax free salary? If tax is paid on the salary by the employee, then such tax is also considered as salary. Then there is a charging section and computation section in salary. The charging section is section 15, computation section is section 17, and 16 talks about deductions. So what does the charging section say? The charging section says that salary is taxed on due or receipt whichever is earlier. Due or receipt whichever is earlier. Very simple. Now let's come to computation section. Computation section has defines salary under section 17 subsection 1. So salary is an inclusive definition which includes basic salary, wages, pension, advance, allowances, everything. Okay. Then section 17 subsection 2 talks about perquisites. To know what is perquisite, it is better to differentiate between allowances and perquisites. So allowances is a fixed amount that is received, but perquisite is a variable amount and it depends on the amount spent on the benefit or facility. Okay. Allowances is given whether the amount is spent or not spent, but perquisite is only given when it is incurred. Okay. Perquisite can be in cash also, it can be in kind also. Then 17 subsection 3 is profit in lieu of salary. These are all the capital receipts which are taxed under salary head of income. What are they? Number 1, compensation on termination of employment, then compensation on modification in terms of employment, payment from the retirement benefits, that is Provident fund or any other fund, then key man insurance policy, and then lastly lump sum or any other amount before joining employment or after cessation of employment, that is after completion of employment. Then one by one we saw the different terms that are taxed under salary head of income. Firstly, we saw basic salary. Basic salary means regularly the income which is received by the employee every month, it is taxed under salary head of income. Then dearness allowance. Dearness allowance is also fully taxable. But why we are studying this separately? Because there are two types of DA. DA which forms part of retirement benefits, which is DA in terms, and DA which does not form part of retirement benefits, it means DA not in terms. Then if nothing is given in the question, you can assume that DA is in terms and solve the question. Even if you assume DA is not in terms, that is also correct. Then if any fees is given to the employee, such fees is also taxable under salary head of income. If any commission is given to employee, such commission also fully taxable under salary head of income. Why we are learning commission separately? Because there are two types of commission. One is turnover commission, one is other than turnover commission. Turnover commission means it's a percentage of the turnover which is achieved by the employee. Other commission means any other commission. Then bonus. Bonus is also taxable under salary head, and bonus is only taxed on receipt basis. Then advance salary. Advance salary is also taxable in the hands of employee. So advance salary means what? Salary that is given in advance. Since salary is taxed on due or receipt whichever is earlier, hence when employee is receiving salary in advance, then also he has to pay the tax. Sir, what will happen when it is due? When it is due, since the tax has already been paid, you need not pay the tax once again. However, you have to be very careful. and differentiate between advance salary and advance against salary. Advance against salary is a loan which is given to the employee. So you should treat it as a loan. It should not be taxed under salary head of income, and you should also see whether this loan is given at a concessional interest rate, and you have to find out the perquisites on such loan. Then arrears of salary. Arrears of salary is the disputed salary of the past which is received in the previous year. Arrear of salary is also taxable if it is not taxed earlier. And in case of arrears of salary, the employee also receives section 89 relief. We talked about 89 relief yesterday, where we should add all the arrear salary. So before arrear salary, we should compute the total income and taxes. After salary, we should compute the total income and taxes. The difference between the tax will be called arrear tax. You have to find out the arrear tax in all the respective years. Then arrear tax of the assessment year minus arrear tax of that years will be the relief under section 89. If you look at the question in your study material, you will be even more clear. Now, coming to the deductions under salary chapter, there are three types of deduction: standard deduction, entertainment allowance, and professional tax. Firstly, let's come to standard deduction. Standard deduction is a peculiar case because standard deduction is a deduction which is a lower deduction in old regime and higher deduction in new regime. So in old regime, the standard deduction is 50,000, and in new regime, the standard deduction is 75,000. Okay, so this is a new amendment which is applicable only from May 25 examinations onwards. Then let's come to entertainment allowance. Entertainment allowance is only allowed in old regime, not allowed in new regime. Only allowed in old, not allowed in new. So in old regime also, this entertainment allowance is only allowed to whom? Government employees. So government employees can take the benefit of entertainment allowance. So first and foremost, you add the entertainment allowance to the salary, because it is also a portion which is an amount which is given by the employer. So first add it to the salary, and then you can claim deduction. The deduction is 1/5 of basic salary, or actual entertainment allowance received, or 5,000 for the entire year kanna, whichever is lower. So maximum is how much? 5,000 only. Next, professional tax. Professional tax is the tax on employment paid in that particular state. Okay, if professional tax is paid by the employer, then first add it to the salary and then take deduction. If it is paid by the employee, then directly take as deduction. No need to add it to the salary. Moreover, professional tax also only allowed in the old regime, not allowed in the new regime. Fine. Now let's come to the retirement benefits. Firstly, we are going to discuss gratuity. So gratuity is a voluntary payment that is given by the employer to the employee in appreciation of the employee's services. Now, how to calculate the exemption and tax on gratuity, taxable income on gratuity? Firstly, if gratuity is received during the service, it is fully taxable. During the service, fully taxable. What if it is received on death or retirement? And here retirement includes resignation also. So death, retirement, resignation, incapacitation, there is an exemption which is available under section 10 clause 10. Okay, and this exemption for government employees, it is fully exempt. So gratuity received on retirement or death by a government employee, fully exempt. Then what about other than government employee? You have to see whether the employee is covered under Payment of Gratuity Act or not covered under Payment of Gratuity Act. If the employee is covered under Payment of Gratuity Act, then what is the exemption that can be claimed? So the exemption is, number one, the limit of 20 lakh rupees. Highest limit is what? 20 lakh rupees, or actual gratuity received, or 15 divided by 26. So 15th August by 26th January multiplied by salary. What is this salary? Basic plus DA. So in DA in terms also will come, not in terms also will come, both. Okay, so basic plus DA is the salary, and here you should take the latest salary multiplied by number of years of service rounded off. Here in rounding off, only one special point. If it is 10 years 5 months, it will become 10 years. If it is 10 year 11 months, it will become 11 years. But if it is exactly 10 years 6 months, it will become 10 years only. So 10 years 6 months, you have to do lower rounding. Fine, lower rounding. So 15 divided by 26 multiplied by basic plus DA salary, that is latest, multiplied by number of years of service rounded off. So you have to find the lower of all the three. This will be the exempt gratuity. Balance amount will be the taxable gratuity. Then what if employee is not covered under Payment of Gratuity Act? In such case, the upper limit is how much? 20 lakh rupees, or actual gratuity received, or 1 by 2, that is half of the average salary 3. Average means what? 10-month average before the month of retirement. 10-month average before the month of retirement multiplied by salary. Average of what? Salary. Here what is the salary? Basic salary plus DA terms plus commission turnover. Basic salary, DA terms, commission turnover. So you have to add all these three. Then you have to find out the average of the last 10 months before the month of retirement, and then you have to do it into 1 by 2 multiplied by number of completed years of service. Number of completed years of service. So even if 26 years 11 months is completed, you should take how much? Only 26 years. The completed years alone you have to take. So by this you will be able to find out the exemption in gratuity. Balance amount will be taxable gratuity. Now a small note, retirement gratuity which is given to members of defense is completely exempt, and if a gratuity is already received, and already some exemption has been claimed, then you have to remember that the 20 lakhs is the lifetime maximum exemption. So already if you have claimed some exemption, let's say the employee claimed an exemption of 8 lakh rupees, then the balance 12 lakhs only can be claimed further. So you have to change the limit from 20 lakhs to 12 lakhs. Okay. Then now let's talk about pension. Pension is the periodic payment that is received due to past services. Generally, pension is received month on month. It is received in annuity, that is every month. If pension is received in annuity, or it is also called as uncommuted pension, in such case it is fully taxable. Uncommuted pension, fully taxable. However, sometimes the employee can commute the pension. What is commuting of pension? I gave you an example that 60% of the pension of 10,000 per month is given up. So the employee gives up 60% of the monthly pension to receive 3 lakh rupees lump sum amount today. Hence the future pension will be what? 4,000 rupees per month. So the pension is 10,000, 60% is given up. So future pension is only 4,000. But for this giving up, he has received 3 lakh rupees as a lump sum amount. This 3 lakh is only called commuted pension. Karna, whenever the employee receives commuted pension, then exemption is available under section 10 clause 10a. Section 10 clause 10a. Here also you have to see whether the employee receives gratuity or does not receive gratuity. Because receives gratuity means he is getting already gratuity benefit or gratuity exemption benefit. Hence, the exemption allowed for pension is full pension into 1 by 3. But if the employee does not receive gratuity, the exemption will be full pension into 1 by 2, which is a higher exemption. Now, listen very carefully. This is not commuted pension. Here you are using full pension for the calculation. Now, what is full pension? Full pension means commuted pension divided by commutation percentage, or in short, full pension means had the employee given up the entire salary, how much money the employee would have received. That is only called full pension. So in this case, full pension is 3 lakhs divided by 60%, which is 5 lakhs. Okay. Now, next, if commuted pension is received due to an annuity plan of LIC, Life Insurance Corporation, fully exempt. If commuted pension is received by High Court or Supreme Court judge, it is fully exempt. Now let us come to one more special point in commuted pension, that in commuted pension there is no salary definition karna. There is no salary definition while calculating the exemption. You only have to use the full pension. Next, leave encashment. Leave encashment means what? The encashment of the leave which is not taken by the employee. Encashment of leave not taken by the employee. If leave encashment is received during employment, fully taxable. On retirement, the exemption is available under section 10 clause 10AA. Section 10 clause 10AA. For government employees, fully exempt. Government employee, fully exempt, need not do any calculation. Other than government employee, then you have to take lower of the following as exemption. Balance amount will be taxable. So what is lower of what? Number 1, the full limit of 25 lakh rupees. Limit of 25 lakh rupees, or actual leave encashment received, or leave equivalent divide by 30 into average salary, or 10-month average salary, 10 month multiplied by average salary. Now listen here. Here, what is salary? Salary is basic plus DA terms plus commission turnover. Basic plus DA terms plus commission turnover, and average should be 10-month average before the date of retirement. 10-month, not before month, before date of retirement. In gratuity calculation, it is 10 months before month of retirement. In leave encashment, it is 10 months before date of retirement. So before date of retirement, you have to take 10 month salary. That 10 month salary you have to do average, okay, and this average only you have to divide it by, this average only you have to multiply it by 10 months for the first step. Now second step, you have to calculate leave equivalent. Leave equivalent. What is leave equivalent? Earned leave minus actual leave. Earned leave minus actual leave. But here be very careful. Earned leave should be maximum how much? 30 days per year. 30 days per year. Okay. So in question it is given 45 days or 50 days. You have to restrict it to 30 days, and then you have to reduce it. Then you have to reduce the actual leave, which will give you the leave equivalent. Okay. Next. Similar to gratuity, here I made you change the limit. In this page there was an error, so I made you change it to 25 lakhs. I hope you have changed. So now total limit is how much? 25 lakh rupees. It is a lifetime limit. Hence, leave encashment exemption, if already claimed earlier, then such earlier claimed exemption should be reduced from the limit, and balance only can be claimed in future. Okay. Next, now we are going to see voluntary retirement scheme. Voluntary retirement scheme means what? A scheme which is given by the company, where the company wants to reduce its employees. So the company is telling you take a lump sum amount from us and voluntarily retire from the company. This is called voluntary retirement scheme. In case of amount received by the company, exemption is available under section 10 clause 10c. But to claim this exemption, you have to follow certain conditions. What are the conditions? Conditions are given under rule 2BA. Number 1, employee should have completed at least 10 years of service or 40 years of age. But this age condition and service condition not applicable to PSU, that is public sector undertaking. Then director of a company and cooperative society, VRS is not eligible. Then purpose of VRS should be the overall reduction in the strength of the employees. Vacancy from the VRS should not be filled up. The retiring employee shall not be employed in any other concern with the same management, and maximum exemption is only up to the prescribed limits. Now what is the prescribed limit? Lower of the following. Number 1, maximum limit is how much? 5 lakhs. Maximum 5 lakhs, or actual VRS received, or salary multiplied by balance months of service left, or salary multiplied by 3 months multiplied by number of years of services completed. So now we are seeing the second point, salary multiplied by balance months of service left. So what is salary? You take the basic plus DA terms plus commission turnover, and you take the latest salary. Okay, not average, you take the latest salary. Then when it comes to the first step, latest salary, the same, multiplied by 3 months multiplied by number of years of service completed. So if 25 years 8 months is completed, you have to take how much? 25 years only. Okay. Next, retrenchment compensation. Retrenchment compensation is compulsory reduction in the number of employees. The employees are not given a choice, they are directly asked to leave. In case of retrenchment, what happens? The compensation is payable as per Industrial Disputes Act. Hence, when compensation is received as per Industrial Disputes Act, exemption is available under section 10 clause 10b. What is the exemption? Compensation under Industrial Disputes Act, or actual compensation, or 5 lakh rupees, whichever is lower. Now let's come to Provident Fund. So Provident Fund are of 4 types. 3 types are for employer-employee relationship, and the last one is for self-employed. So first let us see self-employed. What is self-employed? PPF, that is Public Provident Fund. So in Public Provident Fund, the individual can contribute any amount, and after the specified number of years with interest he will receive back the amount. Now let's come to employer-employee relationship. There are three types: recognized provident fund, unrecognized provident fund, statutory provident fund. First let us talk about statutory provident fund. Statutory provident fund is governed by PF Act of 1925, and generally statutory provident fund is for whom? It is for government employees. Now let's come to other than government employees. They have recognized, unrecognized. Recognized means what? It is recognized by income tax commissioner. Unrecognized means not recognized by income tax commissioner. Now let us see what is superannuation fund. Superannuation fund is also a retirement benefit like a provident fund. It can also be approved superannuation fund or unapproved superannuation fund. If it is approved, it means approved by income tax commissioner. Unapproved means not approved by income tax commissioner. Now, how is this provident fund and superannuation fund taxed? We are going to see all the aspects. What will happen when there is a contribution? What will happen when there is a maturity? Contribution பண்ணும்போது என்ன ஆகும்? Maturity வாங்கும்போது என்ன ஆகும்? So firstly, let us talk about statutory provident fund. Statutory provident fund. So when the employer is contributing, it is fully exempt. When employee is contributing, see, the employee contribution is not an income. It is only using the already taxed income. So when employee is contributing, you should ignore, you should not tax it. Also, the employee will get a benefit of deduction under section 80C in the old tax regime. Fine. So employee contribution. Next, interest will be fully exempt. Maturity also fully exempt. Okay. So employer contribution fully exempt. Employee contribution ignore. Interest is fully exempt. Maturity is fully exempt under section 10 clause 11. Then recognized provident fund. In recognized provident fund, the employer contribution is exempt up to 12% of salary. Okay, 12% of salary, and here salary means what? Basic plus DA terms plus commission turnover. In your examination, sometimes they will tell 20% of basic. 20% of basic. So you should not do minus 12%. Okay, what you should do? You should do 12% of basic plus DA terms plus commission turnover. You should do 12% of basic plus DA terms plus commission turnover, and this value only you should minus. The silly mistake that is done by students in this type of question is directly they will do 20 minus 12. Okay, so you have to see that for calculating the 12% limit, you have to take basic plus DA terms plus commission turnover. Okay, so up to 12% it is exempt. If it is going more than 12%, then the excess amount will be taxable under salary, head of income. Okay, then employee contribution, here also ignore it, and employee can claim deduction under section 80C in the old tax regime. Then interest also is exempt up to 9.5% per annum, but if it is going more than 9.5%, excess amount is taxable. Then what about maturity? Generally, maturity is exempt under section 10 clause 12. Maturity from recognized provident fund is exempt. However, it is exempt only subject to a condition. What is the condition? The employee should be a participant in the recognized provident fund for at least 5 years. If he is going outside the recognized provident fund or withdrawing the money before 5 years, then it should be because of 3 reasons. What are the 3 reasons? Number 1, due to ill health. Number 2, due to discontinuance of employer's business. Number 3, for any other cause which is beyond the control of employee. If it is because of these 3 reasons, it is okay. You can withdraw before 5 years also. Sir, it is not because of these 3 reasons also. Then what to do? Then there is one more option, Karna. You ask your new employer to convert the existing recognized provident fund to new employer's recognized provident fund. Then the same recognized provident fund will continue. So no problem. Or you ask the new employer to convert from the old RPF to new NPS, that is new pension scheme. Then also no problem. But this also cannot be done. Then nothing can be done. It is fully taxable. How will it be taxable? It will be taxable just like unrecognized provident fund. So let us see how is unrecognized provident fund taxed. Number one, in case of unrecognized provident fund, if employer is contributing, then no tax. Employee is contributing, you ignore, but deduction is also not available. For unrecognized provident fund, no deduction. Okay. Then in case of interest, it is not taxable when the interest is credited. However, in the maturity, everything is taxable. How to compute the taxable income on maturity of unrecognized provident fund? I told you, you have to divide this unrecognized provident fund into 4 parts. Maturity amount into 4 parts. Employee contribution, interest on employee contribution, employer contribution, interest on employer contribution. So employer contribution and interest on employer contribution will be taxable in the salary head of income. Employee contribution will never be taxed because it is already taxed income, and interest on employee contribution will be taxable under income from other sources. Like this, you have to tax the maturity of unrecognized provident fund. Sir, what about maturity of recognized provident fund? Whenever maturity of recognized provident fund is taxable, then you have to tax it in the same manner, but make sure that from this taxable income, you should reduce the already taxed income, which is greater than 12% or greater than 9.5%. This you have to reduce, and balance only you have to tax, because if an income is already taxed, you should not tax it once again. Next, public provident fund. When it is public provident fund, employer contribution not applicable, employee contribution, it is application of income, so ignore, but you can claim ATC deduction. Then what about interest? It is fully exempt. Maturity, it is fully exempt under section 10 clause 11. Then approved superannuation fund, unapproved superannuation fund. Very simple. In approved superannuation fund, employer contribution exempt, employee contribution not applicable. Then interest is exempt, maturity also exempt if lump sum amount is received on death or retirement under section 10 clause 13. Then unapproved superannuation fund is taxed in the same manner like a unrecognized provident fund. So same manner. Okay. Now let's come to the next layer. So first layer we saw the taxability above 12%, above 9.5%, then taxability on maturity. Now let's come to the second layer. What is the second layer? As per the second layer, we are going to see section 17 subsection 2 clause 7, where if employer is contributing more than 7.5 lakh rupees in 3 funds combined. What are the 3 funds? Recognized provident fund, national pension scheme, approved superannuation fund. In all these 3 funds combined, if the employer is contributing more than 7.5 lakh rupees, then the excess amount over and above 7.5 lakh rupees will be taxable under the salary head of income as perquisite. As perquisite. We saw a question where 7,77,600 was the employer contribution. So 27,600, which is the income amount above 7,50,000 was taxed in the hands of employee. Okay. This 27,600 is only called PC, which is perquisite contribution. PC means what? Perquisite contribution. Now 17 to 7A. So not only this amount above 750 will be taxable, this greater amount is there, no, 27,600 which we computed. The interest on such amount will be taxable. Okay, and the interest which is received next year also will be taxable. Then the interest on such interest also will be taxable year on year. So this is a complicated calculation. How to do that calculation? We learnt it through a formula. What is that formula? TP is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. So TP is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. Okay. So this is one section and this is the another section. Both sections you have to find out separately, then add it together. Okay. Now what is TP? TP is taxable perquisite. Taxable perquisite as per 17 to 7A, which is what? That interest amount that you are going to find. Okay. Then what is PC? Perquisite contribution. Perquisite contribution is what? Amount in excess of 7,50,000 rupees divided by 2 multiplied by R. R means rate. How to find out the rate? income by fund average, I by F average. Income means what? Income of all the three funds during the year. Okay, income of all the three funds during the year. If during the examination income is not given directly, you have to find out indirectly. How to find out indirectly? Take the closing balance, from this reduce the opening balance, reduce the employer contribution, reduce the employee contribution, balance amount is the income. Then F average, it means what? Fund average. Fund average, very simple, opening balance plus closing balance divide by 2. So like this you will get the fund average. Income divided by fund average equal to R. Now sir, what is this PC1 and TP1? Answer is, this section was applicable from 1/4/2020 onwards. So from the previous year 2021 onwards, for all the previous year before the previous year relevant to you, that is 24-25. So previous year 2021, 21-22, 22-23, 23-24. For all these 4 years, what was the PC and what was the TP? You have to take everything combined. This is only PC1 and TP1. Okay, this also you have to multiply by R, that is I divided by F average. You will get the total income which is taxable under section 17 to 7A. Then now next layer, what is the next layer? Kana, employer contribution in excess of 750 is taxable. Employee contribution in excess of 2.5 lakhs or 5 lakhs is also taxable. Listen here, employee contribution, I told it can never be taxed. It can never be taxed because it is application of income. But interest on this employee contribution will be taxable. What is the limit? If the employee is only contributing, employer is not contributing, then the limit is 5 lakhs. But if employer is also contributing, then the limit is 2,50,000. If employer-employee both are contributing, the limit is 2,50,000. If employer is not contributing, only employee is contributing, then the limit is 5 lakhs. Okay, if employee is contributing more than this limit, that is more than 2,50,000 or 5 lakhs, then the interest on the excess amount will be taxable. Interest on excess amount will be taxable. Okay, so here you need not calculate the exact interest. Even if you mention that the interest on this amount will be taxable in your answer, it will be okay. Now let us, with this we have completed the retirement benefits, and now we are going to move to allowances. We are moving to allowances. So in allowances there are three types of allowance: fully exempt, partly exempt and fully taxable. So fully exempt allowances, what are they? Allowance given to High Court judge or Supreme Court judge, compensatory allowance given as per Article 222 of the Constitution, allowance given by United Nations Organization, Section 10 Clause 7 allowance. What is this? The the allowance given by Indian government to Indian citizen working outside India. It is exempt. Perquisite also exempt, we learnt. Then specified allowance to past and retired member or chairman of UPSC is also exempt. So this is from question answer point of view not that relevant, but maybe if multiple choice question is coming, you should be ready to answer. Now partly exempt allowances. In partly exempt allowance, firstly let us learn house rent allowance. Section 10 clause 13A, house rent allowance. First and foremost, house rent allowance only allowed in old regime, not allowed in new regime. Only allowed in old regime, not allowed in new regime. Okay, so exemption is available for house rent allowance. What is the exemption? Exemption under section 10 clause 13A is lower of the following: 40% or 50% of salary, or actual HRA, or rent paid minus 10% of salary, whichever is lower. So 40% when you have to do when it's a non-metro city, 50% in case of metro city. And here metro city only means MDCK, Mumbai, Delhi, Chennai, Kolkata. Mumbai, Delhi, Chennai, Kolkata. So for these 4 cities, if the employee is working there, take 50% of salary. If employee is working in any other city, take 40% of salary. And here also salary is salary 3, which is what? Basic plus DA terms plus commission turnover. Okay. Then actual HRA received, then rent paid minus 10% of salary. Salary is basic plus DA terms plus commission turnover. Okay. Then be very careful that this HRA exemption is there. No, it is only available for the relevant period. It means the period for which the accommodation was occupied by the employee. So for what period you have to calculate HRA? Only for the period for which the employee was occupying that accommodation. For the balance period, exemption is not available. Okay, even though HRA was given, it will not be available if employee is not occupying the accommodation. Now let's come to section 10 clause 14. In section 10 clause 14, there are two parts: 10 clause 14 subclause 1, 10 clause 14 subclause 2. First, we are going to see what 10 clause 14 subclause 1. There are 6 items in 10 clause 14 subclause 1 where all the 6 will be exempt to the extent of amount spent on official purpose. So if amount is spent on official purpose, entire amount is exempt. Whatever amount is not spent will become taxable. What are the 6 items? Number 1, conveyance allowance, that is for traveling within the city. Number 2, uniform allowance, that is for stitching a new uniform. Number 3, research allowance, which is for research or training. Generally it is given by research institutions, colleges, okay, laboratories, etc. Then daily allowance, to meet the day-to-day expense while they are on tour. So if I am going to another city to work and there my employer is providing me day-to-day expense, then it is called daily allowance. Then helper allowance, giving a helper for office work. So helper allowance is given, helper is not given, helper allowance is given. Traveling allowance, traveling allowance means from traveling from one city to another city, it is called traveling allowance for work purpose. Okay, so whatever amount is spent for work purpose, for what? Conveyance allowance, uniform allowance, research allowance, daily allowance, helper allowance and traveling allowance. So here I have put one mnemonic, that is curd HT. If you want, you can use it also. Conveyance, uniform, research, daily, helper and traveling. So for all these, whatever amount spent for official purpose is exempt. Okay, then section 10 clause 14 subclause 2, allowance which are having limits, allowance which are having limits. Okay, so tribal area, scheduled area or agency area allowance, maximum exemption is how much? 200 rupees per month. Transport system allowance, which is nothing but daily allowance which is given to transport system employees. Maximum allowance is how much? 70% of allowance or 10,000 per month, whichever is lower. Then transport allowance, transport allowance means home to office, office to home, only given to specially abled employees. So specially abled employees can claim an exemption of 3,200 per month maximum. Okay, then underground allowance, underground allowance maximum limit is how much? 800 rupees per month. Children education allowance, maximum 100 per month per child, maximum 2 children. Okay, hostel allowance for children, 300 per month per child, maximum 2 children. So these are all the exemptions. Okay, now listen very carefully. For the new tax regime, only 4 of these allowances are you can claim exemption, balance you will not be able to claim exemption. What are those 4? Daily allowance, conveyance allowance, traveling allowance and then transport allowance. Daily, traveling, conveyance and transport. So here you have conveyance allowance, daily allowance, traveling allowance and transport allowance. So transport allowance is what? For specially abled employees. Okay, that is allowed in the new tax regime also. Apart from that, the 3 official purpose, that is conveyance, daily and traveling, will also be allowed in new tax regime. So whatever amount is spent for official purpose will be allowed as exemption. Okay, next let us come to perquisites. Let us come to perquisites. In perquisites also 3 types: fully exempt perquisites, partly exempt perquisites and fully taxable perquisites. Firstly, let us see what are the fully exempt perquisites. Number 1, telephone bill or mobile bill paid by the employer. So if employer is paying the phone bill, it is fully exempt. Then tax on non-monetary perquisites. So if tax is paid by the employer on non-monetary perquisites, then such tax, it is a benefit. Employee or the tax when they are pay pandranga employer, but still it is exempt. But listen here, since it is exempt here, no, it is not allowed as deduction in PGBP. It is not allowed as deduction in PGBP. So tax paid on non-monetary perks of employee is exempt in the hands of employee and disallowed in the hands of employer. So employer cannot claim it as expense and employee need not treat it as income. Next, section 10 clause 7, we saw it. the Indian government giving perquisite to Indian citizen outside India, it is totally exempt. Next, conveyance given to High Court, Supreme Court judge is exempt. If the employer is selling goods at a discounted price to the employee, then such discount is also exempt. Then, if transport facility is given to the employees, then it is completely exempt. Then, if training is given to the employees, that is also completely exempt. Next, partly exempt perquisites. In partly exempt perquisites, firstly we are going to see leave travel concession, LTC, one of the favorite questions for the examiner. This leave travel concession is also not applicable for new tax regime, only applicable for old tax regime. So in salary chapter, no, you will see many places where it is not applicable for new tax, only applicable for old tax. There is only one and only place where new tax regime is higher than old tax, that is standard deduction. Okay, 75,000 instead of 50,000. Everywhere else, new tax regime is a disadvantage, old tax regime only advantage. Okay, so leave travel concession. When employer is sponsoring the leave travel of the employees, then exemption is available under section 10 clause 5. What is the exemption? If air travel is sponsored, then economy fare of the national carrier, that is Air India, or actual expense, whichever is lower. In the question, if you are getting any other carrier also, take that carrier amount. Fine. Economic class, don't take business class. Next, any other mode now you have to see whether rail service is available. If rail service is available, actual expense or first class rail fare, whichever is lower. If rail service is not available, then see whether recognized public transport system is available. If recognized public transport system is available, then deluxe fare or actual expense, whichever is lower. If that also not available, then see what is the rail fare for the similar distance. For similar distance, take the railway first class fare or actual expense, whichever is lower. So this will be the exemption under LTC. Balance amount will be taxable. Sir, is LTC exemption available only for the travel ticket of employee? Answer is no. It is available for travel ticket of employee also and family members also. Who are these family members? Employee plus spouse plus children plus parents, brother, sister if dependent on the employee. Okay, employee, spouse, children, parents, brother, sister if dependent. And here there is a cap on the number of children also. If children are born on or after 1/10/1998, then what is the upper limit? Maximum 2 children. However, there can be more than 2 children also exempt if born on or after 1/10/1998. That is available only in case of first one child was born and the second time birth was multiple births. In such case, for all the children it will be allowed. But what if first twins are born and then third child is born? In such case it is available? Answer is no, because first itself twins were born. Okay. Next, leave travel concession is available for 2 times in a 4-year block. Here I told you to change the notes. I think you have revised it. I have by mistake given 31.3. Please change it to 31.12. So the current block which is going on is 1/1/2022 to 31/12/2025. It is a calendar year block. Okay, January to December. In this 4 calendar year block, LTC exemption can be claimed 2 times. Sir, but I did not claim LTC exemption, or I claimed only one LTC exemption. In such case, one LTC exemption you can carry forward to the next year, but more than one you cannot carry forward. Maximum one you can carry forward. So next block I can use LTC 3 times instead of 4 times. Okay, but maximum 3 times only. Beyond that it cannot go. LTC to High Court and Supreme Court judges exempt. And one more point, if LTC exemption can be availed only if the travel is done within India. Outside India, no exemption available. Okay. Next, medical facility. Medical facility, let us see what will happen if treatment is in India, treatment is outside India, and in insurance related cases. Firstly, let us see what happens if treatment is in India. If the employer is giving the treatment to the employee or his family members within India. Who is family kanna? Here also family means spouse plus children plus parents, brother, sister if dependent. But here on the children there is no maximum limit. So employee and family members. they can get treatment and the employer can sponsor that treatment or he can provide the treatment. In both cases, exemption is available on the perquisite. What is the exemption? Number one, if treatment is done in employer's own hospital, it is fully exempt. Employer's own hospital, fully exempt. Next, if it is done in the government hospital or government approved hospital, then also fully exempt. And number three, if it is a prescribed disease and proof is given about the prescribed disease, then also it is fully exempt. And then four, if illness is relating to COVID-19, then also exemption is available based on few conditions. What are the conditions? COVID-19 positive report should be there. Then document of diagnosis or treatment within 6 months of the COVID-19 positive report and certification in respect of all the expenditure. If these three proofs are given, then even if COVID treatment is done in a private hospital, the exemption will be allowed. Okay. In balance all cases, it will be taxable. So treatment given to grandfather, taxable. Treatment given to in private clinic, it is fully taxable. Fine. Next, treatment. Sir, what if treatment is given outside India? If treatment is outside India, the treatment is available for employee and family members. So that should be only one patient and one attendant. The patient can be employee or family members and maximum one attendant. There cannot be more than one attendant. If there is more than one attendant, for the second attendant onwards, it will not be exempt. It will be fully taxable. So for employee plus one attendant, what is the exemption available? Exemption for treatment plus stay. Treatment plus stay is what? Actual expense or RBI limit, whichever is lower. Okay, actual expense or RBI limit, whichever is lower. Sir, what about travel? For travel, you have to see whether the gross total income of employee is up to 2 lakhs. If it is up to 2 lakhs, travel is also exempt. If it is not up to, if it is more than 2 lakhs, then it is taxable. Okay. Then insurances. If health insurance is paid by the employer for the employee, that is mediclaim of employee paid by the employer, fully exempt. Reimbursement of health insurance also fully exempt. Personal accident policy, fully exempt. Staff group insurance scheme, fully exempt. But remember one thing, life insurance is fully taxable. If employer is paying life insurance for the employee, fully taxable. Next, hospital here includes dispensary and nursing home also. So it is, if it is a government or employer related nursery or dispensing home, then also exemption will be available. Now let's talk about education. In case of education, if employer is sponsoring the education of employee, fully exempt. Employee's education, fully exempt. Employee children education, let us see. There are two conditions. Number one, value of education should be up to 1000 rupees per month per child, and it should be either employer's own institution or a tie-up institution. So two conditions should be satisfied. The value of education should be up to 1000 per month per child. And listen here, this 1000 per month per child is there, no? This you should not take in the same institution. This you should see the similar institution in same locality. Okay, for example, if the employee children are studying in Delhi public school and nearby there is Indian public school which is same type of education, then compare with the fees of Indian public school. If it is not given in question, then only you see the fees of Delhi public school which is given to other students. Okay, so if it is within 1000 per month per child, fully exempt. It is more than 1000, fully taxable. More than 1000, fully taxable. Sir, what about any other person other than employee and children? It will be fully taxable perquisite. Whatever expense the employer is incurring for education of employee's spouse or any other person, that will be fully taxable perquisite. Next, free tickets to transport employees. So if free tickets or passes are given to transport employees, then in case of airline employee, if air tickets are given, fully exempt. Railway employee, rail tickets are given, fully exempt. Any other employee, fully taxable. Next, sir, what about food? If food contains alcoholic beverage is fully taxable. For other than alcoholic beverage, you have to see whether it is given in normal area or remote area. If it is given in remote area, fully exempt. If it is given in normal area, number one, if it is refreshment like tea, coffee, bhaji, bonda, snacks, etc., it is fully exempt. If it is other than refreshment, that is meals like lunch or dinner, then it should be provided either in office or a meal voucher should be given, and that voucher should be up to 50 rupees only. If it is more than 50 rupees, it is fully taxable. More than 50, fully taxable. Okay. Then club or recreation. If club or recreation benefit is extended to all employees in general and it is related to health or sports club or similar facility, that is for fitness, then it is fully exempt. Sir, what about other cases? In other cases, if it is a corporate membership, then the initial membership cost is there, no? That will not form part of perquisite. Only if any amount is spent for the specific employee later on, it will form part of perquisite. And what if it is not a corporate membership? Then the amount spent for that employee will become perquisite. Okay. Sir, what if this club is there? No, it is fully for official purpose. If it is fully for official purpose, it means what? It should be for official purpose. Details should be maintained by employer. An employer should give a certificate that it was only for official purpose. If all these three conditions satisfied, then it will not form part of perquisites. It will be fully exempt. Then rent-free accommodation. Rent-free accommodation, very important, because amendment has also come and it is one of the favorite question for the examiners. So listen very carefully. Rent-free accommodation means what? An accommodation that is provided by the employer to the employee at either it is rent-free or it is at a concessional rent. It means what? Very little rent is collected from the employee. So firstly, let us see what will happen if it is a government employee. If it is a government employee, then you will see that there is a license fee which is prescribed by the government. This license fee is only the value of perquisite. Government employee kaila exempt illa kanna. It is not exempt in the hands of government employee. It is fully taxable. How to find out the value of that salary only we are seeing. That is the value of perquisite. The value of perquisite is what? License fee that is prescribed by government. From this you should reduce any rent that is recovered from the employee. Okay, balance amount will be taxable in the hands of employee. Sir, what about other employees? And also listen, sir, what if there is a government employee and there is no license fee available? In such case also see other employee category. In other employee category, you should see whether the property is employer property or other property. Employer property or other property. If it is other person's property, then rent paid by employer should be perquisite. Correct? Rent paid by the employer only should be perquisite. However, there is a upper limit. What is the upper limit? 10% of salary. 10% of salary. So what is the salary in this case? Salary in this case is what? ABB CDM. ABB CDM. A means what? Taxable allowance. Taxable allowance. B means what? Basic pay. B means what? Bonus. C means what? Commission. D means what? DA terms. Why are, see, allowance liye DA vandiruchu. Why are we writing DA separately? Because it is DA terms. Only DA terms you should take. DA not in terms you should not take. And M means all other monetary payments. Okay. What you should not take? You should not take AABB. You should not take arrears of salary. Okay. You should not take any advanced salary. You should not take any perquisites, and also you should not take any PF or any other retirement benefit. So ABB CDM, taxable allowances, basic pay, bonus, commission, DA terms, monetary payments, any other monetary payment. You should consider all this. You should add all this. This will become salary. 10% of this salary is only the upper limit. 10% of salary is the upper limit. So either rent paid by employer, maximum how much? 10% of salary. Okay. From this you have to reduce if any rent is already paid by employee. Balance amount will be taxable perquisite. Sir, what if it is employer's own property? If it is employer's own property, no, then you should see the city where the employee is living. What is the population? What is the population? If the population as per 2011 census, so if you are having the book, if you have not made this correction, please make this correction. Okay. If it is the, you have to see the population as per 2011 census. If it is up to 15 lakhs, take 5%. Above 15 lakh up to 40 lakh, take 7.5%. Above 40 lakhs, take 10%. So up to 15 lakh, 5%. Above 15 lakh up to 40 lakh, 7.5%. Above 40 lakh, 10%. Okay. 10 percentage what? Of salary. Salary multiplied by 5, 7.5 or 10 percentage will be the upper limit. Okay. Minus rent paid by employee. Now listen, sir, what if furniture is also given, TV is also given, AC is also given? In such case, all these are what? These are movable assets. In movable assets, what did we learn? We learned that in case of movable asset, if it is hired by the employer, take the perquisite value as higher charges paid by the employer. If it is employer's own movable asset, take the perquisite as 10 percentage of the cost. 10 percentage of cost. So in furniture also, if it is other people furniture, higher charges paid by employer. If it is employer's own furniture, 10 percentage of the cost. Okay. Now let us see some special points. Number 1, there is an amendment which is applicable only from May 25 onwards. What is that amendment? There is now a cost inflation index based upper limit for rent free accommodation. Cost inflation index based upper limit for rent free accommodation. What is that upper limit? Listen here. In 23-24, whatever was the rent free accommodation, this you take, and this you have to multiply by, divide by cost inflation index of the preceding previous year, multiplied by cost inflation index of the previous year. So when we are talking about previous year 24-25, you have to take perquisite, that is rent free accommodation perquisite value of 23-24, divide by cost inflation index of 23-24, that is 348, multiplied by cost inflation index of 24-25, which is 363. So you will get the maximum value of rent free accommodation. If whatever you found it as a rent free accommodation perquisite, if it is more than this maximum limit, then restrict it to maximum limit. So maximum ivladhan, idukku mela taanda kudadu. Okay va? After doing all this calculation, compare it with maximum. Next, sir, if there is transfer of employee and 2 accommodations are given for the employee. For example, I am employed in Coimbatore. Now I am transferred to Chennai. With my family, I was living in Coimbatore. Now in Chennai, they have given me a new house, but I have requested that it will take some time for my family to move to the new house. That is why I want to keep both houses. In such case, up to 90 days, you can take lower of both the houses. If it is more than 90 days, then beyond 90 days, take both house value as perquisites. Okay. Then if house rent free accommodation is given to High Court, Supreme Court judge or member of parliament or union minister or leader of opposition, it is fully exempt. Now let's come to hotel benefit. So the employer is sponsoring the hotel stay of the employee. In such case, what will happen? Taxable perks will be 24% of the salary. This is the same salary what we learned for rent free accommodation, ABB CDM. Okay, 24% of salary or rent or charges paid by the employer, whichever is lower, minus if any amount is recovered from the employee. Okay. However, if there is a transfer of the employee and hotel stay is given only up to 15 days, then there is no perquisite. There is no perquisite. Next, motor car. Motor car. When a motor car is given to the employee, then you have to see whether the car is used only for official purpose, only for personal purpose, or partly official, partly personal purpose. Only for official purpose na, it is fully exempt. Only for official purpose, fully exempt. Okay va? Then when it is for personal purpose, then treat it as a movable asset. Personal purpose na treat it as a movable asset. Movable asset la enna பண்ணுவீங்க? Employer's car or hired car. If it is employer's car, 10% of cost. If it is a hired car, then higher charges paid by the employer. Now confusion comes only in what? Partly official, partly personal purpose. You have to see whether it is employee's car or employer car. If car also belongs to employee, charges, running and maintenance expense also done by employee, then no perquisite at all, because everything is done by employee only. But if car belongs to employee, running and maintenance paid by employer, then what you have to do? You have to first take what are the running and maintenance expense paid by the employer. Then from this you reduce 1800 per month up to 1600 cc or 2400 per month up to more than 1600 cc. So you have to reduce this and balance will be perks. Sir, what if when we are reducing, we are getting negative answer? Negative answer means no perks. Okay, wow. Negative answer means no perquisite. And this 1600cc is also called 1.6 liter engine. More than 1600cc means more than 1.6 liter engine. So both wording can come in the examination. Now, employer car. This employer car is only mostly tested in the examination. So listen carefully. If the car belongs to employer and if the running and maintenance is paid by employee, then perquisite value will be 600 per month up to 1600cc, 900 per month more than 1600cc. But if car also employer, running and maintenance also employer, this is only most frequently asked in examination. Car also employer, running and maintenance also employer. In such case, 1800 per month will be the perquisite value up to 1600cc, 2400 per month greater than 1600cc. Then if driver is also provided by employer or chauffeur is also provided by employer, then add 900 per month also along with this perquisite. Okay, sir, there is more than one POPP car, more than one car used for partly official, partly personal purpose. In such case, treat one car as partly official, partly personal. All the remaining car will be fully personal. Fully personal. Sir, loan is given at a concessional rate to the employee. If loan is given at a concessional rate, number one, see whether the loan is only up to 20,000. If yes, ignore it. See if the loan is given for specified diseases. If yes, ignore it. If loan is not up to more than 20,000 rupees or not for specified disease, then perquisite of interest will be how much? Loan value multiplied by SBI interest rate on the first day of previous year minus actual interest rate. In this loan value, when you should take on every month closing balance, take every month closing balance multiplied by SBI interest rate minus actual interest rate. Okay. Now, gift, voucher, token, etc. So, gift, voucher, token, etc. If cash is given to the employee, cash means what? Only cash? No, it means money also. It can be given through bank also. If money is given to employee, fully taxable. But if it is other than money, gift, voucher, gift, then you should see fair market value. Fair market value is up to 4,999. If fair market value up to 4,999, it is exempt. If it is 5,000 or more, it is taxable. Okay, be very careful. Up to 4,999 exempt, 5,000 or more taxable. Next, travel, tour, accommodation, etc. So if travel, tour or accommodation is provided and this is other than leave travel concession. Leave travel concession, you see that section. Other than leave travel concession means you have to see whether it is for official purpose or not for official purpose. If it is for official purpose, then in case of employee, it is exempt. Employee's family, it is taxable. Whatever amount incurred is taxable. If it is not for official purpose, then if it is offered to all the employees, it is fully taxable. The amount incurred by employer is perked. If it is only for specific employees, then the similar agency what is providing in the market, that value will be taxable. Okay. In general, this is not that important. In general, if such leave travel expense is incurred by the employer, whatever amount incurred by the employer for family will be fully taxable, and for employee other than official purpose will be fully taxable. Okay. Next, specified security or sweat equity. Specified security or sweat equity or employee stock option plan. What are these? These are nothing but shares of the employer given to the employee at concessional price. Shares given at concessional price. So here, when the employee exercises the option means what? Means they are getting the shares from the employer. Sometimes the employee cannot exercise the option immediately. They have to wait for 2 years or 3 years or 4 years. So after 2 years or 3 years or 4 years, when they are getting the shares, at that time only the perks will arise. Perks will arise. So what? How to calculate the perks? Perks is equal to fair market value minus issue price. Perks is what? Fair market value minus issue price. Now how to calculate this fair market value? See if the shares are listed in stock exchange. If it is listed in stock exchange, then first take the highest volume stock exchange. In NSE and BSE, take the highest volume. In that highest volume, opening balance plus closing balance divide by 2 will be the fair market value. Sir, what if during the exercise date the stock exchange was on a holiday? In such case, take the previous traded date and take the closing balance. Don't take average, take the closing balance of the previously traded date. Sir, what if the shares are not recognized in stock exchange? In such case, take the value which is determined by merchant banker. But listen here, when it comes to sweat equity shares, okay, that is employee stock option plan, the employees face a difficulty. What is the difficulty? Is that when they are getting the employee stock option plan, when they are getting it, in that year only the government is taxing it. But now they are having the shares. Have they sold the shares? No. So they are not having the money even to pay the tax sometimes. The shares value will be so much, they will not be having the money to pay the tax. So sometimes they are forced to sell the shares. Okay, this is a unfortunate situation. But in this unfortunate situation, one relief is given to whom? To startup employees. One relief is given to startup employees. So to startup employees, they can postpone the taxability of ESOPs. So how much they can postpone? See here, tax on perquisites, okay, is taxable in the year whichever is earlier. So out of the three, whichever is earlier, ESOPs will be taxed. Number 1, after the expiry of 48 months from the end of relevant assessment year, or sale of share takes place, or the employee ceases to be the employee of the employer. Okay, so either the employee leaves the organization, or the employee is selling the shares, or 48 months from the end of relevant assessment year. So end of relevant assessment year for 24-25 is what? 31/3/2026. From there you have to calculate 4 years, that is 31/3/2030. Okay. Now use of movable asset, we already saw that in case of movable asset, if it is hired by employer, higher charges paid by employer. If it is owned by employer, then 10% of cost. However, listen, computer laptop, if it is given to the employee for using, then no perquisite at all. Even if employee is using fully for personal purpose, does not matter, it is fully exempt perquisite, computer and laptop. Next, transfer of movable asset. First, what did we see? Using the movable asset. Now we are seeing transfer of movable asset. Now employer is telling the employee, "Niye in the asset vechiko." They are giving the asset to the employee, or maybe taking some small amount from the employee. In such case, how to calculate the taxable perquisite? For this, you have to calculate the WDV, and this WDV is not the WDV in section 32 of PGBP. This is a different WDV. This WDV is what, in case of computer or laptop, the WDV is 50% WDV method. In case of car, it is 20% WDV method. In any other asset, it is 10% straight line method. 10% straight line method. That means what? 10% of cost will be calculated, and every year that cost will be reduced. That is only straight line method. And depreciation is only for completed years. And this completed years also, you should not take financial year. You should see the completed years from the date of purchase of the asset. So for example, I told you that the car was purchased on 1/10/2022 and the car was given to employee on 30/9/2023. Value of the car was 10 lakhs. So when was 1 year completed? Car was given on 15/9/2024. 15/9/2024. So 1 year was completed on 30/9/2023. Was the next year completed? Answer is no. 30/9/2024 did not come. So only 1 year is completed. So 20% depreciation, WDV method, you get the value as 8 lakhs. This 8 lakhs will become the perquisite value in the hands of employee. Next, other taxable perquisites. So if employer is providing gas, electricity or water supply to the employee, that is also taxable. If the employer is providing a free domestic help, that is also taxable. If employer is paying the credit card expense of the employee, that is also taxable. However, if credit card expense is for official purpose, it is not taxable. Then if employer is paying any obligation of the employee, then also it is fully taxable. Listen here, what is obligation of the employee? Obligation of the employee means if the employer would not have paid the amount, still employee would have definitely paid the amount. Okay, if employer would not have reimbursed, then also employee should compulsorily pay. This is only obligation of employee met by the employer. That is also fully taxable. Now let us learn about non-specified and specified employees. Sir, non-specified employees means small employee, specified employees means big employees. Specified employees means big employees. Who are those big employees? Whose salary is more than 50,000 per year. Whose salary is more than 50,000 rupees per year. They are big employees, means specified employees, or employee having 20% or more voting power, or directors. So these three employees are specified employees. For specified employees, you should learn the provisions as I taught you. But if the employee is non-specified employee, there is one benefit which is given to non-specified. What is the benefit? 5 types of perquisite fully exempt. 5 perquisites fully exempt. What are they? Number 1, education facility. Number 2, transport free tickets. Number 3, free domestic help. Number 4, gas, electricity, water. Number 5, motor car. Education, transport facility, free domestic help, gas, electricity, water, and motor car. So these are fully exempt. So relief under section 89 we already saw. Then I told you about concept of pay scale. So if in the question you see something like 10,000, 2,000, 14,000, then it means what? It means that initially the salary is 10,000, then after 1 year the salary will be increased by 2,000 and it will become 14,000. Sorry, 12,000. 12,000. Then next year again it will be increased by 2,000 and it will become 14,000. So this is only pay scale. So it will be increasing by 2,000, 2,000 every year till it reaches 14,000. You get my point? This is only concept of pay scale. Then there is 80CCH, which is Agniveer Corpus Fund. Now we are going to discuss this in detail when we are learning the deduction chapter. For now you just know that Agniveer Corpus Fund, if the employer is contributing, then the employer contribution is fully taxable in the hands of employee. And whatever employer contribution is there, it can also be claimed as deduction under section 80CCH, that we will be discussing in 80CCH section, deduction chapter. Hush.